I'm Charlotte McLeod with the Investing News Network, and here today with me is Adam Rozencwajg, Managing Partner at Goehring and Rozencwajg. Thank you so much for joining me online today. Great to see you.
Nice to see you again, Charlotte, as well.
Yeah, nice to be catching up with you. And, we've talked in the past about a number of different topics. We've gone over oil and gas, uranium, and copper, but we've never really had a chance to look at gold. I was thinking with the metal trading at still historically high levels, now is the time to look at what's got us here and what's coming next. So you actually recently just put out a Q1 research report. And in it, you mentioned how it looks like gold is entering the next leg of the bull market. So if you could maybe start by situating us in terms of where we're at in the gold cycle right now.
Yeah, sure, absolutely. So, we have been gold bulls for quite some time, but we've actually been mostly out of the gold market. And that might sound like a strange combination, but the reason that we were is going all the way back to 2020. We started to see a lot of indications that the gold to oil ratio had really switched in the favor of energy. So obviously, oil went negative in the middle of COVID. Gold prices were hanging in fairly well. And we had this unbelievable opportunity that we saw emerging in the energy side of the complex. But something else happened back then that made us think that perhaps gold might take a breather in an otherwise strong bull move, which we think will basically last most of this decade. And weirdly enough, what that was is that was silver. And the reason why silver gave us a little bit of a sell signal on gold was the idea that silver outperforms gold in a strong precious metals bull market. And that's always been the common wisdom. But that kind of is not 100% accurate. Now, it might be true that you can look at sort of total percent changes and what have you, but what that misses is the idea that for a long time in historical precious metal bull markets, silver will actually lag gold. And that was true in the early 1970s when gold dramatically outperformed silver for the first two and a half years of the bull market. And then silver stages this massive catch-up rally, and it closes that gap entirely. And what you actually get is silver pulls ahead of gold in terms of total performance. Now, that ironically, that's your cue in the past anyway, that perhaps the precious metal bull market is about to take a little bit of a breather. And that's what happened this time as well. So we got those two signals at the same time. We had this idea that silver staged this catch-up rally, which in the past has been a sign that maybe you're going to get a bit of a breather. And you had the fact that on a relative valuation basis, the gold to oil ratio was so favorably skewed towards energy. And we'd never had a reading like that in which oil did not massively outperform gold. And that was the case this time as well. So we used that as our cue to get out of the gold market in 2020. And that was the right call. People that follow us might know that we are early on things and we're not really the best timers of markets. We're pretty good at analyzing them, but we're not great at timing them. And this is one of the rare timing calls that we got right. So we've been waiting for our opportunity to get back involved in the gold bull market. And for a lot of reasons, which I'm sure we'll spend most of today talking about, I think we're basically at that point today. So now we think that gold has entered into a new phase of its bull market, probably started in the third and fourth quarter of last year. It really revolves around central banks' behavior as much as anything else. And I think it's going to propel gold much, much higher in this new leg of the bull market.
Yeah, so we had those two signals for you that said, okay, maybe now is time to take a step back. And let's talk about the signal that is telling you, all right, now it's time to be picking up. You mentioned the central banks. And I know based on the report that that's a factor that you're really kind of seeing great significance from. So let's hear a little bit about that if you could.
Sure, absolutely. So, all the way in the early part of last year, we started to, sharpen our pencils and say, okay, when is this turn in gold really going to take place? And we put out a roadmap like we like to do with a few different factors we would like to see in it. And one had to do with Western speculator buying and selling, and speculators had liquidated a lot of gold during COVID. The second had to do with central banks, which had actually stopped buying gold during most of COVID and actually turned to sell gold in some cases to try to free up some money in order to pay for their different social programs related to the COVID shutdowns, stimuluses, and stuff like that. And then, of course, like I said, the gold to oil ratio. So all of those started to look better in the beginning part of 2021. And what you, of course, had working against you was the idea that you were raising interest rates so significantly in the United States. And we had the sharpest interest rate hike cycle really in modern history. And of course, in that environment, that's going to be a headwind for gold. And so those were kind of the different forces buffeting the gold market last year. And then everything changed in the fourth quarter. And the central bank stepped in as a massive, massive buyer of gold in the fourth quarter. And then it continued into the first quarter of 2023, which is the most recent data we have available. And in many cases, in an aggregate group, the central banks bought more gold in the fourth quarter than they had at any time since the world went off the gold standard in the late 1960s, early 1970s. And in many cases, for individual countries, they bought more gold than they've ever bought in their history. So something seems to be changing. And I think that something is going to drive the gold price substantially higher. And remember, central bank gold purchases are largely price insensitive. So I think it's so important when you look at gold and you look at the buyers and the sellers and you say, who's the most price sensitive in this? And when you have price inelastic buying, that's the recipe for much higher prices. Just like when you have price inelastic selling, that's what drives prices much, much lower. When the central banks sold all their gold in the late 1990s, worst call they ever could have made, they made the bottom in the gold market because they went out to the market and they sold without much regard for price. And I think now they've re-entered. They've re-entered to a small degree over the last decade, but now they've re-entered in a very material fashion and they're price insensitive, and that's going to drive prices much, much higher.
All right. And what are your thoughts on why the central banks are doing this large amount of buying? What are your thoughts?
Well, there's a lot of ideas being thrown around, and to a large extent, which I think is so interesting, is that a lot of these ideas have been thrown around for some time. There's been a feeling that the United States is going to lose its reserve currency status. And as some of your listeners and watchers likely know, um, for the last 40 years, the United States has really been the reserve currency. Since we've stopped the Bretton Woods exchange standard, which pegged a lot of currencies together through the Bretton Woods exchange agreement. Following that period, which really ended abruptly in 1971, the U.S. has been the default reserve currency of the world. Now, what does that mean? That means that when China and Australia trade, when Australia sells coal to China, they settle it in dollars. They don't settle it in Australian dollars. They don't settle it in renminbi. They settle it in US dollars. And in fact, the majority of the global commodity trade is all settled in US dollars. And what that means is that around the world, everyone has to hold a huge amount of US dollars in order to facilitate trade settlement. And they recycle that into treasury securities and things of that nature. And it allows the United States to run consistent and sustained budget deficits. However, we think that could now be changing. And for a long time, people have said that was an unsustainable model. And we point out a few people, but there's a number of different newsletter writers and research analysts. Some of my favorite are Louis Gave of Gavicol and Zoltan Pozsar, formerly of Credit Suisse, wrote very, very, very well. And Mr. Grumman from Forest for the Trees has written for basically a decade that Russia and China were desperate to start settling commodity trades outside of the dollar. And if that were to happen, then that would be a really, really important shift in the global monetary system. There's only one problem. There was never any evidence that was actually happening. You could make the case over and over again that it was unsustainable, and you could say that the U.S. was running imprudent fiscal policies and that the U.S. had political discord that made it not a good candidate for a global hegemonic power, and that their empire was fading like Britain's was after World War I and certainly after World War II. But the problem was, while all those arguments might have been valid, you weren't seeing anyone move away from the US dollar. You still settled all of your global currency or all your global trade in dollars. And even when the US so-called weaponized the dollar through the SWIFT system, which occurred for the first time, you can make the debate, but there's been several creeping instances of it over the last really 20 years since 9/11, where the U.S. has used its position as global clearing agent in order to push a political agenda. although that was aggressive action, it never caused anyone to look elsewhere. Everyone basically bent and continued to use the dollar as the reserve currency standard. Even the Swiss, basically agreed to get rid of their U.S. clients to avoid, the position that they were put under to try to violate their Bank Secrecy Acts. That's now starting to change, and I think that's what's super important. These arguments have been ones that we've followed for a long time, and we're not sensationalists in any regard. And frankly, we don't have not believed up until now that there's been any chance of the U.S. losing its reserve currency status, basically because there was no evidence that it was happening. Now that's beginning to change. France has announced that they're going to sell LNG to China in renminbi. Brazil is going to sell soy and iron ore to China, denominated in renminbi. And Saudi Arabia is negotiating now with China in order to sell its crude oil to China, again, settled outside of the dollar. What does that have to do with gold? Well, two things, really. First of all, anytime you're going to get a major monetary shock like that, like the end of a reserve currency system and bringing in a new system, I think that's going to be really good for gold. And I'll explain why in a second. But secondly, and what I think is maybe a little bit easier and less abstract, is that if you have all these countries and they start trading with China, there's going to be an accumulation. There's going to be an imbalance. If you look at how Saudi trades with China, they sell more oil to China than they import Chinese goods back to Saudi. So what you're going to end up with is renminbi that accumulate in Saudi Arabia or in whoever the commodity exporting country is. And what do you do with those? The nice things about the US dollar is that they are the reserve currency. You can use them anywhere. You can go and use them as collateral. You can take them to London and buy a townhouse in Belgravia. You can go to the south of France, wherever you want. The Chinese renminbi is a much more closed capital system, and there's really nothing to do with it other than buy Chinese goods. And so what the indications are looking like is that you will at least use some gold to try and balance any big trade surpluses or deficits, meaning that, in the case of China and Brazil, you would sell all your soybeans to China, collect renminbi, buy as many Chinese goods as your economy could handle. And then with whatever leftover renminbi, you'd be able to exchange at least a portion of that back on the Shanghai Gold Exchange for gold and use that to repatriate your capital. That's not a gold standard explicitly by any means. That is still very much a fiat paper system. However, it would use gold, at least on the margins, to help balance trade imbalances and deficits and surpluses. And to me, that would be very consistent with the activity that we're now seeing amongst these central banks accumulating huge positions in gold in their reserves. Both China, Russia, Brazil, India, Singapore, a lot of these countries that I think would potentially be, in this new position. So I think the big thing is not, like it was the famous saying about going broke. How does it happen? Slowly at first, and then suddenly. I think it's sort of like the writing's been on the wall here for a long time. I still don't think that this is 100% likelihood of happening, but it's gone from a very low likelihood to at least something that needs to be taken seriously. And in that type of a world, gold would do very, very, very well.
Right. Yeah. I was going to ask you, what is the timeline for this? But it's something that we need to keep watching and see if it actually does happen. And then the other thing that was coming to mind is, okay, in this new type of monetary system, where does the balance of power start to fall? Does it start to shift toward countries with more gold, or how does that look to you?
Well, that's a really interesting question. And I think, certainly there's a lot of shifts that would begin to take place. I think the, notable loser would probably be the United States, in the sense that if the easiest analog would be Britain after World War I, but really World War II, where they lost their global reserve currency status and all of a sudden had to live within their fiscal means. And it became a very difficult time for Britain, with several sterling crisis and pound crisis that occurred throughout the 50s and 60s and 70s. So I think that is something to worry about. I think that, I guess naively, you might look at some of the gold producing countries and say, well, they should do well there. Although with such a shock, the unintended consequences are always difficult to firmly peg down. I think the emerging markets would end up doing quite well. And again, Louis Gav has written some really interesting articles about what a new sort of Asia centric or Southeast Asian centric trading bloc might look like, where basically instead of recycling excess US dollars into treasuries and then having the US lend domestically or to emerging markets, the Chinese, through their Chinese government bond recycling mechanisms, might actually push liquidity into its sphere of influence directly, which would really liquefy a lot of those emerging markets. So I think the answer is to remain open-minded and probably expand one's limits in terms of what the possible outcomes could be. I think we're in a little bit of a shifting, or the time is potential for a bit of a shift here. But here's something that's really interesting to consider, and something that I think will do very, very, very well. You know, we've shown many times this chart that compares the price of commodities to the price of financial assets. And we've dragged it back 140 years. And when you go all the way back um, over several cycles, you see that every time commodities get really, really cheap relative to financial assets, a lot of the same things happen. You have easy credit, you have investment manias, you have malinvestment, and you have commodity prices that fall. And then they become a wonderful time to get involved in the commodity business. So we're at one of those times right now. We've been arguing that really for a few years. We've been early with COVID. We had a double bottom. It worked. It didn't work. But I think when we look back on this decade, we're very clearly in a bull run here that'll take commodity prices higher through the balance of this decade until investment is restored. But the interesting question is, what was the catalyst at all of those bottoms to start a new bull market in earnest? And in every case, it was a change in the global monetary system. The first was the end of the classical gold exchange standard in 1929. The second was the end of the Bretton Woods exchange standard, or gold's convertibility, or gold's US dollars gold backing, which everyone thinks happened in 71, but it's really Johnson that took the US dollar off gold in 68 by removing the law that said the dollar had to be backed by gold. Now, of course, when you say the dollar doesn't have to be backed by gold, the day you do that, it still is backed by gold. And so it took 2 years to run out of gold and have Nixon shut the gold window, but that started in 68. And then in 99, when the LTCM blew up and you had the Asian currency crisis, half of the developed market, or developing markets rather, changed their monetary system and decided to competitively devalue their currency. And it resulted in, $6 trillion basically eventually winding up in foreign central bank reserves. So these were massive shifts in the global monetary system, and each one of them corresponded to the low point in the commodity price relative to financial asset chart. So here we have another bottom, the cheapest priced commodities have ever been relative to financial assets. And we've been saying since 2018 that, I bet it's going to be a change in the global monetary system. And so I think that we're starting to see that now. Again, these are trends that you could have seen coming for a long time, but I think they're actually starting to play out as we speak.
All right, that's really interesting. And so for you, central banks, monetary shift, these are really important factors for gold. What else is on your list when it comes to watching gold? Because when I have these conversations, we're talking about other things like the Fed, inflation, banking crisis, all these different things. How do you rank those kinds of things?
Well, right now, I do think that the central banks are in the driver's seat. I think that to the extent that we have further rate hikes in the United States, that will be a headwind for gold. However, I think at this point, given that we're through, I would say, even if you're a real hawk, I think people agree that we're probably more than halfway through the rate hike cycle at this point after 500 and change basis points inside of a year. I think that you're likely past the worst of that as far as a headwind. If you get another series of rate hikes, will that have short-term impacts, negative impacts on gold? It's very possible. But it seems as though the headlines now are more dominated by the central bank buying, and particularly since that fourth quarter buying was followed through with continued first quarter buying this year as well. So it was not sort of an isolated incident or blip. Um, you know, if you had a global financial contagion or banking crisis or panic, what we have seen in the past is that will in fact lead to gold selling off as it's sold to provide money and liquidity along with every other asset. So it gets caught up in this vortex. We saw that in 2008, but then it bounced right back and eventually made its cycle highs. So I think that if that happens again, these are probably short term in nature. As far as you know, Western speculators, I think that's something you can watch as well, although the liquidation there seems to have slowed. And although you're not in a new accumulation phase, they no longer seem to be shedding gold quite as aggressively. The other thing is that the positioning of the speculators on the COMEX are pretty bearish still, which is usually a good sign. When the speculators actually go net long and the commercials go or sorry, when the commercials go net long and speculators go net short, that tends to be a really good buy signal in the precious metals market. We had that signal in silver. We haven't had it in gold, but nevertheless, I think that's their positioning is still on the more bearish side, which is ironically, if you think they're the dumb money, is positive. So I think that the stars are fairly aligned for gold right now, and I think that we've firmly entered now into the second leg of this gold bull market, which, by the way, in the 1970s, gold had a massive pullback in 73, 74. The Fed raised rates aggressively to try to tame inflation, just like they're doing now. Gold pulled back like 50% from peak to trough. Silver, well, gold stocks are down like 70 or 80%. And then it was off to the races through the back half of the 1970s. And I think we're probably going to fill this similar type of a pattern this time, except the drawdown in gold and silver prices has not been as bad this time. And I think the reason it hasn't been as bad is that the central banks are now buying.
Okay, so I've heard that in order to have the gold price really take off, not that we're not quite high right now, you have to have all your sources of demand kind of lining up. Does that make sense to you? Is that kind of what you're thinking?
Yeah, I guess that's interesting. Look, I suppose that makes sense. Although, when you do think about it, for every buyer, there has to be a seller. So when I think about the gold market, I usually try to think about the price sensitivity of who's doing the buying and who's doing the selling. The Indian and Chinese buyers, physical buyers, retail physical tend to be very price sensitive, and speculators tend to be they chase price. So price is almost they're the opposite of price sensitive. When price goes up, they want more. When price falls, they want less. Central banks are agnostic. They tend to make their policy decision, and then whatever the cost is, the cost is. So I think if you have central banks buying, that's bullish. I think that if you have the physical retail group bleeding gold out into that central bank buying, that's quite positive. And then eventually, I think you're right that you probably will get the Western speculator who chases that trend and comes back. And that's probably where you push things into unsustainable territory later this decade.
Okay, very interesting. And, of course, when we talk about gold, people always want to know, what do all these factors add up to in terms of the price trajectory? And I know you've made a comparison for precious metals to the 1970s. So if you could maybe talk about how the price situation plays out for now.
Sure. So look, I think that our price target for gold has five figures in it, and it's probably, I would guess it's like in the $12,000 to $15,000 an ounce range, and we're going to write an upcoming essay about gold valuation in the next quarterly letter, and so that might sound shocking. Maybe it doesn't. Depends who your listeners are, but that number's not made up. It comes from a few different factors. One would be looking at the historical relationship between how much gold the government holds versus how many dollars are out there. So even though we went off of gold, the amount of ounces that we held became fixed starting in the late 1960s, early 1970s. But the price, of course, moved, and so you can still compute the implied gold backing, even though it's not an actual gold backing, and it's moved in patterns that are kind of interesting. At times, the dollar gets backed by a lot of gold, and that usually means that that gold is overvalued relative to the dollar, and vice versa. So if you use that as a metric, you get to $15,000 per ounce. That takes you back to a fairly high backing, similar to what you had at other market tops. right? So I'm not saying it's the fair price, but that's where things got in 1980, and that's where things got again in the late 1920s. Um, Now, the other way you could do it is by looking at the relationship of gold to total financial assets, and that makes sense in the sense that gold is an asset. It should have some type of a weighting in a global basket of wealth and of productive assets, and it does. You know, you can look again over time, and it's not that it's a fixed asset allocation, but you can see that it moves in bands, and when it gets really cheap, it tends to be a good investment. And when it gets really expensive, it tends to top out and the price begins to roll over. And so if you do that again, you know, total global financial assets relative to total above ground gold stock, you're talking about $15,000 per ounce, you know, easily. So that's always kind of been our long-term price forecast on gold. That's never been, you know, how we model gold companies. But in the long term, that is where we think, you know, a fair cycle will take precious metals this time. But the near term headwinds, notably central banks that were no longer buying, speculators that were shedding, and oil that was dirt cheap relative to gold, meant that we felt that the more attractive investment for people was on the energy side of the ledger book. And now I think that it's pretty compelling to have both, quite frankly. So I think that the corrective phase that we've been talking about, that we said would last 2 to 3 years and started in 2020, is now coming to an end. And I think the next leg of this strong bull market that ultimately will take gold above $10,000 an ounce is very much in play.
Okay, really good to know the thought process on gold. And I know we said we'd be talking about gold, but I'm going to throw in a quick question on silver because, it has similar drivers to gold, but not all the same because it's got its industrial side. What happens to this silver price in this scenario? Do you have any thoughts there?
Well, look, I think that silver will probably do the same thing as gold earlier this cycle, meaning it'll lag and lag and lag and lag and then catch this massive catch up bid. And that's probably your sign to get out of the precious metals markets. Again, people love to talk about the differences between gold and silver and how things might have changed to be different this time. Yeah, obviously there's an industrial demand element to it. For a long time in my career, that was a real headwind for silver because we weren't using film anymore. You know, a lot of silver went into the film market. Now it's a big benefit because of all the electronics and things like that. Silver used to be the poor man's gold because it was much cheaper per ounce. And now that you have all these financial ways to buy gold, I don't know that that's quite the same anymore, right? Because you could put $100 to work in gold financially, whereas before, you had to buy an ounce of each, and then you could get gold for much, much, much less. But I do think what we saw take place in 2021 or 2022, I can't remember, 2021, is very, very, very telling because silver, the Reddit crowd tried to corner the silver market at that time, and they spun up a yarn often told in precious metals markets about how JP Morgan was sitting on this massive short position of silver, and they were going to squeeze the shorts out, and all of a sudden, they were going to force capitulation, and the price was going to go much higher. Now, of course, that didn't work. Silver was bid up, I don't know, probably 20% in a week or so, and then it faded shortly thereafter. And the reason that it faded, in my estimation, is because JP Morgan is not sitting on this massive conspiracy theory short position, although I'm sure people in the comments will disagree with me. And ultimately, they were able to bleed material into the market and satisfy. If there really were a short squeeze, that would have potentially been enough to break the back. So I think that's proof that there wasn't. But the point is that people gravitate towards silver from a speculative perspective. They just love it. And it's such a small market, and it is so volatile, and it moves in sympathy at times with gold, that I think this time will be no different. And you will see a massive speculative mania emerge where somebody tries to corner the silver market again. It's just too tempting. It's sitting out there ready to go. And so I think that will probably be the huge catch-up rally later in the cycle that closes that gap. But it's not going to be up and orderly. I think it's going to lag and lag and lag and lag, and then stage this massive Hunt Brothers I guess 3.0 now. That'll be the third time someone tries to corner the silver market.
Okay, that definitely sounds very possible when it comes to silver. So we'll look to see if we have that happening. As we are getting to the end here, I want to ask about how investors should approach gold and silver, mostly gold right now. Because as you mentioned, there's a lot of choices in terms of how you get exposure to the market. So what are your thoughts there?
Well, I think that everyone's investment background and makeup is going to be a little bit different. And luckily in the gold market, there's something for everybody. We at the fund, we're predominantly or entirely an equities fund. So we invest in gold shares. I think there's some really, really attractive opportunities in the gold mining sector right now. This has been left for dead for an awfully long time. Valuation is about as low as I ever recall seeing it. The companies are better shape than I've ever recall seeing them. Also, there's times where they sort of blow their brains out on spending and have levered balance sheets, and 5 billion shares. After a decade of a bear market will kind of instill a little bit of discipline. And so, the companies are in pretty good shape. They have some really good development assets, some challenges to be sure, but we see some really good opportunities there. I think as it forms a broader portion of someone's you know, wealth planning, the idea of owning some physical gold makes sense as well. It's an asset that's no one else's liability. It's outside of the financial system, and it should do well over the next decade. Now, I would caution that however people do it, you do it with the understanding and the humility that the range of outcomes in the precious metals markets is always wider than one would expect it to be. And there will be frustrations and setbacks for sure. And so you should try to remain strong hands and continue to kind of buy and hold, because I think when we look back on the decade, it's no question in my mind that gold will have done its job and done a very, very good one at that. But that's not to say that the path is always smooth. And so I think that people need to do however they can manage the volatility to ensure that they enjoy all of those returns. So that probably means sizing it appropriately and certainly not using leverage and things like that.
Yeah, well, and just one small follow-up. I think we do have people who have positioned themselves, they are ready to go, and they're seeing the same things that you're mentioning. The companies are looking good right now, and they're thinking, but when are they going to move?
Right. Oh, I don't know if they can figure that out. They tell them to reach out to me. Look, we're terrible market timers. Now that that's not a cop out. We obviously try to do our best. What I can tell you is that I think the risk return is soundly in your favor right here and right now. So whether they continue to move sideways, whether they move down a little bit, I think all of those are buying opportunities. And I think the risk here is to the upside because of their very low valuation and the positive tailwinds that they'll get from gold. My suspicion is that gold shares will do quite well. They've actually done pretty good at the beginning part of this year. They provided some nice ballast at a time when other parts of the commodities markets weren't working. And in fact, they've provided some nice balance when other parts of the market have shown some signs of kind of moving sideways, which has not been often in this kind of melt up 2023. So I think that the gold shares are behaving differently. It seems as though the selling pressure is behind them. So hopefully that'll be a good sign that we'll see some strong performance going forward. But I'll be the first to admit that my timing is not the best.
Okay, well, I think that's useful advice in any case. So, as we're finishing up, are there any other points on gold or silver or any of the topics that we've been speaking about that you would leave investors with?
Just that, if you start thinking all the way back to when this commodity and real asset market got really distorted and really out of favor a couple years ago, we really rolled up our sleeves and we tried to look at what could potentially be the catalyst to re-rate real assets. And again, this idea that a central bank shift and a monetary policy shift, more than a central bank shift. I mean, a central bank shift is when they go from loosening to tightening. This is sort of a dismantling of the central bank system. It's a black swan event, but it's not without precedent. It's happened, 4 times in the last 100 years. We've been sort of overdue for a shift. It doesn't mean that the world ends or that the United States, implodes, but it probably does mean that all of this excess pressure in the financial system that's built up and built up and built up of paper assets versus real assets kind of gives way a little bit and starts to revert back to normal. And I think in that environment, real assets in general will do really, really well. Commodity stocks, which have been just, hugely underrepresented in all the indexes in recent years, will do quite well. And gold underpinning all of that is set to probably do historically well. And so I think it's a dangerous time ahead. I think that investors need to leave themselves open to a bigger range of possibilities across all asset classes. Because to me, when you look at the amount of capital that is imbalanced today, you are out on that tail risk where things usually happen, and something has to happen to normalize some of those imbalances. And I suspect we're seeing the beginning of that now.
Okay, I think that is a great note to end on. Thank you so much for coming on today to finally talk about gold. This is really good. I found it easy to follow. I think there's so much good information in there for investors to hear.
Well, thank you so much, and I hope to talk to you again soon.
We will do it again soon. Thank you again. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Adam Rosenzweig with Goehring and Rozencwajg.